Do you have to pay capital gains on the sale of your home? As usual, the IRS makes this somewhat complicated, but there's one specific confusion that I'm going to discuss today. What if you sell your house within 24 months? Do you get to exclude the gain from your taxes? We're going to go over a worksheet. We're going to go over the IRS document. I'm going to make it quick. Let me share my screen. So check this out, publication 523 IRS. Here's what we're trying to determine right here. Does your home qualify for the exclusion of a gain? So just to reiterate, the tax code recognizes the importance of home ownership by allowing you to exclude the gain when you sell your main home. You can qualify potentially for $250,000 if you're a single filer, or $500,000 if you file your taxes jointly with your spouse. Essentially what that means, if you sell your property for $500,000 and you qualify, you can exclude that entire $500,000 gain. You bought it for $100,000, you sell it for $600,000. 20 years later, that $500,000 could be excluded from going on your taxes and paying actual capital gains tax. So to do that, you need to meet 4 criteria. Well, essentially 5 kind of, but we're going to go through the criteria real quick. And then we're going to go to what if you don't qualify and you sell your house essentially within 2 years. So let me show you. Step 1, automatic disqualification for being able to exclude the gain on the sale of a property. You acquired the property through a like-kind exchange, a 1031 exchange, your real estate agent may tell you. You are subject to expatriate tax. I've never seen that. It probably happens. That's why it's in the tax return or the tax document, but I've never seen that. Step 2, this is one of the biggest steps, the ownership, the time and use tests. That's what they call it. Step 2, ownership. If you own the home for at least 24 months. First question, did I own the home for 2 years? No, I only owned it for 18. All right, you're probably excluded, but we're just going through the possibility of you not being excluded. Okay, the possibility of you not being excluded. Step 3, you own the home and use it as your residence for at least 24 months of the previous 5 years. You meet the resident requirement. So you owned it for 24 months and you used it for at least 24 months. The time and use test. If you meet those 2 tests, essentially, you get that full exclusion, $250,000 single, $500,000 married. So again, you meet those tests, you get the full exclusion. But what we're talking about is what if you didn't meet those tests? But I'm just being thorough here. Eligibility step 4, just educating a little bit. Look back. If you didn't sell another home during the 2-year period before the date of sale, you meet the look back requirement. So most people don't do that, but just in case, a lot of people, if you're flipping, doing some crazy things, that might apply. Step 5, exceptions to the eligibility test. So I told you there's kind of 5 steps-ish. These are the exceptions. You can pull this document up, publication 523, and read through these if you would like to. So we're going to scroll down a little bit. Final determination of eligibility. If you meet the ownership, residence, and look back requirements, taking the exception into account, then you meet the eligibility test right there. Bang. Okay. So we're talking about what if you didn't meet that test? What if you only lived there for 18 months? Now you get a potential partial exclusion of gain. Excuse me. To exclude the gain, you need to meet one of these requirements: work-related move, health-related move, unforeseeable events. Okay, so there are a few things that can happen that allow you to qualify for a partial exclusion. So let's say one of these things happen, you need to move and you need to sell your house. One thing, at least 50 miles from home, you potentially qualify for this partial exclusion. Now, what most people do, here's what most people get wrong, is they think that if you live in a home 18 out of 24 months, that's 75% of the exclusion. And you say that you sell the house and you get $200,000 of gains. You sell the house, you get $200,000. People think that you get to exclude 75% of the $200,000 gain, which isn't necessarily true. Let me show you exactly what I mean. So they put a calculator on here for us. So let's go down here. Complete this section only if you've determined that you aren't eligible. So that's what we have discussed here. You're not eligible for the maximum exclusion. You didn't own the home for 2 years. Let's just say that. Okay. Your time of residence in the home during the 5-year period leading up to the sale. Let's just say that's 18 months. Okay. Or you can use this option. Your time of ownership in the home, 18 months. Okay. Step 3, the time that is elapsed between the sale and the date you last sold a home for which you took the exclusion. If it's applicable, let's just say it's not applicable. I'm just going to put a dash here. Okay. That's that third step, essentially, the look back step that you need to apply. Step 2, take the smallest period from step 1, which ours is 18, and divide that number by 730 views in days or 24 views in months. So we're using 18 divided by 24 equals, I got the number here, hang on, 187,500. 187,500. Remember that number. That's 75% of $250,000, which is essentially step 2 here. So I kind of jumped the gun. So we'll put this down here. I jumped the gun. Sorry. Okay. Right here. That's that 187. So we're going to 18 divided by 24 times 250,000 equals 187,500. See what I did there? 75% times $250,000. So multiply the result from step 2, 18, by $250,000. Stop here if not married, filing jointly. So if you're single, that's your number. If you're single, that's your number, 187,500. Remember that. Okay. Step 4, repeat steps 1 through 3 for your spouse and add the 2 results. So say you have a spouse, you essentially just do this. 187,500 times 2. If you were married and your spouse lived there with you the whole time, equals $375,000. Okay. Remember that number. So right here, 187,500 is single, 375 is married, filing jointly. Those are your numbers. So your exclusion limit, let's choose married, filing jointly first. 375,000. Your exclusion limit is $375,000. Let's say you sold your home at a profit of $300,000. If you sold your home for $300,000, that gain is excluded. That's how the proration works. It's the percentage of time compared to the actual full exclusion amount. So instead of you getting $500,000 if you qualify the time the use and look back test, if you qualify for $500,000, that could be excluded. But you only get to take 75% of that. So you get a $375,000 exclusion. So if you sold it for less than 375, or I'm sorry, if you sold it and your capital gain was less than 375, that's tax-free. Congratulations. But if you sold it for 400, now $25,000 needs to go on your tax return. It's different if you're single, though. The limit is smaller if you're single. So anything above $187,000 is taxable. Anything above $187,000 is taxable. This is commonly misconstrued on how this works. I hope this clarifies. Go to your CPA and make sure they know as well. Publication 523. It's right. I mean, it's on the publication. Get mad at me as much as you want, but it's on the publication. Thanks for listening. Peace.